Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. As we wrap up a year that kept the investors on their toes, 2025 year stood out as a period marked by sharp swings, powerful narratives, and even important lessons in patience and discipline that investors had to follow. From shifting market leadership, evolving investor behavior, there were questions around valuations, asset allocation, and long-term strategies. It was definitely a year that was challenged by many long held assumptions as well. So, when we talk about the new year that's going to be coming in, it's going to be better to prepare yourselves with a lot of insight from top market masters who can gauge a lot of upcoming trends and probably help you with in deciding where should your hard earned money go. And therefore, joining us in this special of a year ender, we have Mr. Aashish Somaiyaa joining in with us on this very special. Remember, he's always been with us whenever we do see a change of period. He's the CEO of White Oak Capital AMC, and he's the perfect person who's been tracking the markets, the mutual fund space for more than 2.5 decades to really help us understand how do you really study all those cycles and what do you expect going forward from here. So Ashish, a warm welcome to you and season's greetings to you for this new year, and hope it turns out to be an absolutely fabulous one for you and for your loved ones, for all your clients at White Oak as well. Well, give me a first word as to how do you see 2025 as that year that was wrapped up for investors?
I think it's been a period of kind of testing patience for investors. While we all understand and we should come about to expect that such a year, every once in a while we'll have some such years. If I really think of it from investors' perspective, if you have like a whole year, like now about 12 to 16 months, where the market has been flatlining and practically going nowhere. Because there'll be a lot of people who have seen market going up a lot, and then you have seen phases when market goes down a lot. But I suspect there are not many people who have seen it going nowhere for an extended period of time. From an investor's perspective, really, I think it's not a bad deal because given what we had a year and a half back, poor economic growth, practically zero corporate earnings growth, a tight monetary policy, government which was just coming out of the whole election season. Given all of that happened in 2024, market could have actually been worse off. It could have actually corrected a lot. But instead of that, I think we got a better deal because we've been flatlining. And the great part about the magical part about the stock market is that, if the index remains at the same level for about 12 to 15 months, it automatically gets about, you say 12-15% cheaper automatically. So not a bad deal after all. I mean, people are not happy when they don't make returns. But given what all has happened, given what all has transpired and how badly the market could have otherwise done, I think flatlining for a year is not a bad deal after all. And I think things will eventually get better when we get into 2026.
Okay, Ashish sir, I have to ask you, I think the biggest talk point for investors this time around in 2025 was that nobody imagined the way how gold and silver would outperform the equities as an asset class. I mean, a whopping 182% kind of a rally for silver, an unprecedented kind of a move that we've actually seen. Silver was also being seen as the new gold. Well, gold also, gave almost 80-85% kind of returns here to investors, and compare it with the Nifty.
That is the first point. The second thing is that nothing beats long equity because equity sits at the highest point as far as the value chain of finance is really concerned. Like, we had COVID, such a horrendous period. But even when there was COVID, you saw that digital companies and pharma companies did well, right? Even if gold and silver are doing well, then gold mining companies or these guys who process these metals, they tend to do well. So equity is always the highest up in the value chain or in the hierarchy as far as money making in finance is concerned, and nothing will ultimately beat long equity. So if somebody is a longer term equity investor who is convinced in economic prospects, who understands that when economies do well, corporate profits do well, and when corporate profits rise, stock market performance eventually plays out in their mutual fund NAVs. People who are hardcore equity investors who understand the long term power of equity, they should remain invested in equity. But there will always be some people who lose sleep when they see what happened in the last 1 year. There'll be some people who lose sleep if equity is down 15-20%, right? In those cases, they should be asset allocated. So if you're not a convinced equity investor, then you better be an asset allocated investor. And if you're an asset allocated investor, you may have 50-60% in equity. If you have 50-60% in equity and you cannot tolerate volatility, then the rest of the money should definitely be in debt and gold, right? But the time to change your allocation based on what you've experienced in the last 12 to 15 months, if you're unhappy with what you witnessed, you should by all means change your asset allocation. But the time to change your asset allocation is also over the next couple of years. Rush to buy gold tomorrow morning just because of what you experienced in the last 18 months. If you start rushing to buy gold tomorrow morning, I can tell you gold will go down, equity will go up. So there's no point in chasing the past. You just take the lessons from what you missed and then you see how you want to change over the next couple of years.
Absolutely. I also wanted to get a sense of one more theme that really worked as a frenzy for investors in 2025 was the IPO space. The unprecedented amount of funds that were raised, 1.75 lakh crores odd. The record number of OFS-led fundraise that took place as well. 18 startups that were launched within that. So these are all trends that shaped up 2025. Going forward also the expectation is the same, that the IPO frenzy is not going to die down. But at the same time, by the end of 2025, we still know that about 50% of the IPOs that came in, they have actually slipped below the issue price as well. So the big question going forward is, amidst all of this flood of IPOs that we get, how do you really choose the best one for yourself, the one that will actually go on to reward your portfolios and not feel like you're getting stuck in some IPO. We've seen that in many cases, even in large cap companies like a Tata Capital, for instance, may have disappointed investors, and a Misho would have probably outperformed and given investors rewards. So, and how do you really go about identifying the right IPOs?
So, we are open-minded about it. I mean, we don't generalize. So, White Oak as a house, I mean, there are some IPOs we did participate. We run alternate funds, which are actually pre-IPO funds. In certain cases, we are pre-IPO investors. Sometimes we are anchor investors. Sometimes we participate in IPO. Sometimes we may build our position after listing. So, we look at each one of them case by case. That's the first point. The second is, on your observation that half the IPOs are underwater, I think half of all listed stocks in the last 1 year are underwater. I mean, that is true of the whole market, not just of IPOs. If you look at BSE 500, I think more than half the stocks would be negative in the last 1 year. So nothing special just about IPOs. The third thing is that we should be constructive and we should be happy that so many companies are getting listed, because there's this perception that only new age or tech companies are getting listed. But actually, if you see last 7-8 years, right from 2018 onwards, I have seen our industry, the entire capital markets industry, whether it is asset management, wealth management, broking, registrars, exchanges, depository participants, all of these have got listed in last 7-8 years, and they've been immense wealth creators. If you look at chemicals, look at hospitals, diagnostics, certain pharmaceutical companies, I think there are, as India's economy is rising, as per capita income is rising, there is a large bunch of companies which is coming of age, and that is increasing the investable universe for, the public market managers like us. So I would say that you should be looking at each one of them case by case individually for their own bottom-up characteristics and don't really generalize. And I think there's obviously a lot of criticism when IPOs come that, it's a promoter who's selling, there are investment bankers out there. But look, market reacts to things which market doesn't know. Market doesn't react to things which market already knows. So I don't think you should get too much carried away by all this social media noise about IPOs really. I think as professional or institutional investors, it behooves us to look for opportunities for our investors, and we will be discerning about them. That's the point.
Absolutely. Another space that has underperformed widely and where retail investors have a large chunk of their investments is the small cap space this time around. About a 22-23% kind of a fall is what we have already seen. One of the worst performances since 2018, maybe in 2018 or 19, it had fallen about 7%. It was still okay, but 23% is a huge, huge downtake. And therefore, even if the Nifty would seemingly look like it is reaching its record high level yet again or floating above it, it's the portfolios that are still bleeding. How would you explain to investors what is it that they're doing wrong? What should they be understanding when they deal with small caps? And what do you expect going forward in this space, sir?
So, Sakshi, as a house, we, employ about 35 analysts, which cover about 1100 companies. So that I'm just giving as an example to tell you that we are very constructive about the not only just small cap, but even beyond the top 500 stocks, which fundamentally you would say is micro cap. So we
Okay.
are on the entire space, right? But when it comes to mutual fund investors or generally stock market investors constructing their portfolios, what they should keep in mind is that small cap by character itself is a very volatile space. If you take last 20-25 years of history, on average, in any given year, from the top, the small cap index has declined 20-25%.
Okay.
There are very many years where it falls 20-25% from its previous high. And if you take sporadic, if you take some odd periods, like I'll give you an example, from Jan 2018 till April 2020, it was down 66%. But from April 2020 till October 21, it was up 4x. And
Okay.
then in March 2023, the small cap index came back to the same level as it was in January 2018, which is like 5 years and a quarter back. So I'm just giving you all these examples to tell you it's a very volatile space. We are very constructive on small caps purely because we can generate alpha. Like when we run flexi cap funds, multi cap funds, we feel that significant proportion of our alpha will come from what our team does in the small cap, micro cap space. But because of the inherent volatility of the small cap space, we don't run a exclusive small cap fund. White Oak is probably the only fund house which doesn't have an exclusive small cap fund, despite having very large research and a huge preponderance of small cap exposure in all the diversified funds. Why is that? That is because that space is so volatile that people will enter in 2018, 21, and 24 and get disappointed in 2020, 23, and 25. So the higher the volatility, the bigger is the risk of mistiming your entry and getting disappointed when you get the short end of the stick. So it is inherently a volatile space. It's better that people operate through flexi cap, multi cap, diversified funds or through properly asset allocated portfolios. If you invest a lot of money in small cap, if you get overexposed, then from time to time you are really going to have sleepless nights.
Absolutely. Uh, Also, help us understand, Ashish ji, when it comes to, kind of reallocating, rejigging the portfolios, what are the factors that should go into your mind? What is it that you should be really going big with? And how do you decide those factors? For 2026, for instance, what will be the factors, basis which one will have to think about rejigging or altering their portfolios?
See, there is one simple lesson which I follow. Never rejig or alter your portfolio after taking a beating. Okay, you should, like, in life or philosophically, they say you should always exit at a high, right? So the point is that if you have spent some time, let's say in 2024, if somebody said that I want to rejig my portfolio, and the question is then, okay, why? Oh, because I made too much return. I made more return than what I thought. Oh, that would be a great time to rejig the portfolio, right? But in 2025, after you see underperformed, all this railway, defense, PSU, infrastructure, manufacturing, where people were putting a lot of money, that has underperformed. Quite unexpectedly, gold has outperformed. So there is such a huge polarization in the market that everything which was a darling till last year, the market has murdered all the darlings. And everything which was like IT, for example, till 6 months back, everybody thought, oh my God, IT is just the place not to be in. And now suddenly it's becoming like a contra bet and started to outperform also, right? In end of 2024, suddenly healthcare gave like a massive rally. So what happens is that the market has already murdered all the darlings of 2024. And now in 2025, there are some, disconcerting trends which are being seen. Now, after this, if people want to rejig the portfolio, it's going to be very, very difficult. So I am somebody who would say that after taking a beating, I wouldn't make dramatic changes in the portfolio. Yes, on incremental basis, I would be a bit careful not to put money in the darlings of the past. So on an incremental basis, for example, I would put money into sectors or areas of the market which have underperformed in the past, in the recent past, right? So for example, uh, say private sector banks, say healthcare, IT. I think these are, and then you look at 2026. I think by somewhere in the near future, our market is going to become extremely attractive
Okay.
because for one whole year, index is where it is. But when index remains where it is, 12 to 15%, it automatically gets cheaper. Plus, when sovereign rating is upgraded, obviously your equity risk premium is down. RBI has cut interest rates, and the government and RBI are trying to prime the economy. On top of it, for a foreigner, because the currency is down, we are 8 to 10% cheaper than where we were. And lastly, India has underperformed emerging markets by some 25 to 30%, which is a
Yes.
historic departure from trends. So I think eventually at some point in time when people will start getting enamored with gold and silver because equity has disappointed them, and then they will start talking about rebalancing the portfolio, I think it will be absolutely the wrong time to really do it. So if you take a beating, you take the lessons from it, grit your teeth and live through it, and then make sure you don't repeat the same mistakes. But you can't suddenly change your
True.
portfolio now. I mean, you take a beating on both sides.
Yeah. Since you do say that at some point in time, investors will assess the current valuations and may find Indian market attractive, what about the FIIs, which have so far been evading us? Will they come back in 2026? Is there a strong case that they will find our markets attractive yet again compared to global markets?
Well, yes, I mean, I don't see any reason why that should not happen. But there are a few things which need to go by before that starts to really happen. I've given you all the reasons why our market will start looking attractive. I have no doubts on that. But parallelly also, the US economy, the US market performance, this whole AI-driven up move. I think some questions are being asked now. All the right questions are being asked. But the US has to let up. I mean, look at it this way that last 15 years. See, sitting in India, we've not taken a big beating really because after US, India is the second best performing market globally in dollar terms. US is number one. But the point remains that if US is 15% compounded in dollar terms over the last 15 years, then how will foreigners want to really allocate to emerging markets? I mean, India is a relative rank outperformer compared to other emerging markets. So India has done well in relative terms, and we have actually got good amount of inflow barring 2025. But I think the US has to let up. I mean, if the US market is going to continue to do what it is doing, people will find it difficult to invest in emerging markets. So I think if you look at 2026, somewhere around the corner, I don't know whether it is in next 3 months or next 6 months, at some point in time, I think the US market has to correct. There are some signs or some reasons to believe so. If the US market corrects, then you will see that money moves to emerging markets. And clearly, India will be a huge beneficiary on relative terms, and also the fact that we've not been part of any AI frenzy really. Plus, very strong, solid domestic inward looking economy. And it's becoming cheaper by the day.
Absolutely. Ashish, one more stuff that I wanted to discuss is as far as the earnings growth is concerned. With the kind of slight recovery that we have seen over the last couple of quarters, do they now justify the valuations that we are at, or is there some more scope left there? And do earnings growth have to pick up over the first half of the new calendar year to really justify where we are at?
Yeah, see, I think that we are suffering on two things. See, 2024 clearly was worse off. From there is some minor recovery. And I think, this nominal growth of 8.5, 9% doesn't work well for us. 0.5%, 1% inflation works very well for US, Europe because they pretty much import everything. If US and Europe has 1% inflation, it means somebody in China, Vietnam, Mexico somewhere is absorbing low revenue growth and low wage growth. And hence some of these Western countries, for them maybe 1% inflation is great. For us, I think such low inflation doesn't augur too well, right? Because it's largely a domestic economy and our revenue growth, wage growth, credit growth, tax collection, I mean, a lot of things depend on the nominal GDP growth. The good news is obviously that if you look at the Reserve Bank and the government of India, clearly they are trying to reflate because the Reserve Bank is not only just infusing liquidity or cutting rates, they are actually trying to get the credit markets moving. I mean, for last 12 to 15 years, we never saw them relaxing ECB norms or reducing capital provisioning. So I think some of these things will eventually show the results. And of course, the government are also not just working on supply side, but increasingly moving focus to the demand side as well.
Yes.
So my sense is that all of these things will show some results over the next 6 to 9 months. And if we,
Okay.
but the fact remains that if we don't see better nominal growth and if we don't see sustenance of this trend which has started, then again we will hit some kind of an air pocket. That's why I said that in the next 1 year, I think first 3 to 6 months or some point in time, we need the US market to kind of cool off. And definitely parallelly, we need our numbers also to pan out. So if you were to look at 2026, first 3 to 6 months, I would expect more of the same. More of what is happening, maybe some correction here or there if US corrects. But only in the second half of this year, or maybe the latter part of this period, is when one would actually hope to see some improvement. And everything that I said about markets becoming cheaper, relative
Yeah.
performance, plus some of these fundamentals, I think the second half of 2026 will probably be better than the first half. The first half is obviously, just more of what is happening right now.
Just two quick more questions before we end this. One is, what's a reasonable expectation for the expectations on returns from the benchmark indices next year?
See, in any given year, it would be very normal or logical or rational to assume that whatever is the nominal GDP growth tends to be the earnings growth for the index, and hence similarly the returns for the index itself. It's good that in the last, say, 15, 16 months, we've been flatlining, going nowhere, absolute correction in valuations, relative correction in valuations, and, a reduction in discount rate, better liquidity, government and RBI trying to prime the agency, all of that. So because all of that has happened in last 12 to 16 months, I think the next 1 year will probably be relatively better. So I would say high single digit, low double digit is always a reasonable expectation. But I would again say that, I would still repeat, maybe divide this 1 year into two parts, not two equal parts, but in the earlier period, I expect more of the same. I expect and probably I'm hoping for a correction led more by the US. And the second half is when one would see much better performance.
And lastly, one of the key factors that dominated the market's trend from the very beginning till the very end has been the Trump factor. How do you see that playing out in the new year?
Yeah, see, I think, clearly the market has got distracted a little bit with what is happening, Japanese interest rates and now, of late silver and gold and so many things. But I feel that, clearly the US and obviously the government there is kind of probably recalibrating, or, some of the rhetoric has also kind of started to ease off, right? From time to time, we keep hearing about possibly a US FTA with India, right? I hope that happens somewhere in the next few months. But I think the market has overall got adjusted to not necessarily the best of things to happen, but the market has kind of got adjusted to this whole thing. So it's in the market less and less now, and I think the market has probably assumed that all of this in some form or format will start to get unwound in the next 6 to 12 months. So we have to just watch for it. I think incrementally, if it doesn't get worse, incrementally, if we don't hear too much rhetoric, then we should assume that it's behind us and it will solve itself in the next 6 to 12 months.
Fantastic. Thank you so much then on that note, Aashishji, for being with us on the show. And here's wishing once again a fabulous year ahead to you and to everybody around you as well. Thank you so much for being with us.
Thank you. Thank you very much.
All right, viewers, we'll wrap it up on that note. Another special conversation with a market master on how to prep for the new year 2026. Hope this has given you enough and more insight. Do stay tuned. Much